Hi, welcome to Handout 15, Introduction to Entity Valuation. In this handout, we're going to pull together a lot of the things we've learned recently, like time value of money, discounted cash flow valuation methods, and probabilistic measures of risk, and put these all together to help us value the equity of various entities. The equity meaning the stock, meaning if we bought 100% of the stock, how much would it cost us? And then we'd own 100% of the firm. So as usual, without any further ado, let's jump right in. So first, let's think a little bit about why we care about entity valuation in the first place. Entity valuation comes up in many areas of finance and other related areas. So for example, if we are something like a PE firm, we might want to ask the question, should we buy this firm? Also, we might be a competitor of a firm in the same industry, like, for example, JetBlue, thinking of buying Continental. And we might also be what's called an industry aggregator, and that would be the case where we have a mom and pop kind of industry with no big players across the nation, and we've set out to buy a bunch of them and become a commanding nationwide player. And in these cases, when we're asking this question, do we want to buy the firm? The valuation could be done by a PE firm, an investment bank for an industry aggregator. They might pay an investment bank to do it for them. An M&A firm, if an M&A firm is pitching to, for example, JetBlue, that maybe they should buy United Airlines, they would go ahead and do that as part of their pitch. And in-house teams for industry aggregators might do it themselves. And there are other consultants that do valuations. West End Advisors, my firm, has done valuations for some small companies, for example. Another reason that we care about valuing companies is to establish an equity market value. So if you have a privately held company, for example, it's hard to figure out what the value should be. And some of the techniques that we're going to learn in this chapter will help us out with that. So this would be the case, for example, with shareholders. If we're shareholders of a startup, it hasn't gone public yet, we want to know what our shares are worth. Judges do this type of thing in bankruptcy. The IRS does this type of thing to make sure that firms aren't misrepresenting themselves. And potential investors for startups, like VC venture capital firms, want to have a good estimate of equity market value. So to answer this kind of question, investment banks can do this type of work, or other consultants. And we're also going to be interested in coming chapters in using entity valuation to help us maximize shareholder value of the firm or stakeholder value of the firm. So this is typically an internal type of valuation that might be set out by the board of directors and asking the CEO to ask the CFO to do this. Might also be done by a group of minority shareholders who feel like a given firm isn't run as well as it could be, and if the firm were changed around a bit, its value would go up. So again, this type of work could be done by entities' in-house teams, like the CFO's team, for investment banks who might be doing this for minority shareholders, or for the board of directors, and other consultants. Another time we want to know the valuation of an entity is simply if we want to know, should we buy some shares of the stock of the company? And we've seen the types of investors that want to do this, and do this, in fact, all the time. Typically value investors, like, for example, Warren Buffett. Hedge funds do this all the time. Should we buy 5% of the shares of Google, yes or no? And mutual funds do this all the time. And in this case, this will usually be done by the mutual funds, the hedge funds, Warren Buffett's in-house teams. There are also analysts at the investment banks that will do this and provide their analysis to hedge funds, mutual funds, things like that. Okay, so as we can see, entity valuation, very important, comes up in many different contexts. So what are our valuation methods? Okay, we've beat this drum to death a bit, but first one we learned was the balance sheet valuation method. It's good for steady state entities. The problems with it is it's very hard oftentimes to figure out the market value of assets. When we looked at HCP, the REIT in the first class, for example, valuing what each of their medical labs, each of their hospitals is, putting a market value on each one is difficult and takes a lot of time. And also putting a value on assets that GAAP doesn't even account for is difficult. Things like brand names. What would the Apple brand, sell for if Apple sold itself to Lenovo? I don't know. If we asked everyone in the class, we'd get different answers, and we'd probably want to take an average and look at the standard deviation and stuff like that. So the balance sheet valuation method is difficult. So alternately, we have our discounted cash flow methods, or DCF methods, NPV, IRR, BCR. And as we've learned, the NPV method is good for any project, and that's pretty awesome. So we're going to use it for entity valuation. So our NPV method, as we all know, is we get the NPV, which is equal to the sum of every stinking cash flow for this player, for this project, take each flat cash flow, individually discount them back to t equals 0, add them up, and that's the NPV. If the NPV is greater than 0, the model's telling us it's a good project. If it's less than or equal to 0, pass on it. Okay, so now let's assume that we are buying a firm. So if we're buying a firm, we can rewrite the NPV equation to be more directly applicable to the situation with entities here. We can say that the NPV is equal to minus PP plus the discounted value of all the future cash flows after we purchase the firm. So PP in this case is the price that we pay for the firm. So the NPV will be a big negative cash flow at t equals 0, the price that we pay for the firm. Then what do we get for that? We get the present value of all the future values of the firm. So looking at this in words, it looks like this. We have the price paid for the firm, and that's going to be negative. And then what we get are the present values of all those future cash flows. And again, PP is what we pay now for the right to get all those future cash flows. We get the right by owning 100% of the shares of the firm. So now we want to know in this equation, what are the correct cash flows and what's the correct discount rate to use here? So let's assume we're going to finance the purchase of the firm with our own cash, which we'll call E, and a loan, which we'll call D. So in general, we're going to need to know what the PV is to the owners, that would be the shareholders, the equity holders, or the debt holders, that would be loans or bonds. We take out a loan or we could issue bonds to make this work, and also to all stakeholders, debt holders and shareholders. And for each of these cases, we need to know what are the appropriate cash flows to use and what is the appropriate opportunity cost of capital to use. So let's start with the appropriate cash flows for valuing entities. The appropriate cash flows for valuing entities, the cash flows we're going to get out of the entity if we go ahead and own it, are called free cash flows. So this is very important. You really need to know what free cash flows are. Okay, and the definition of free cash flow for an entity is the maximum amount of cash we can remove from the firm in a period without impairing its future operations. So this is FCF for an entity. So that's the definition. This is an important one to know. And now we got to think about, what does this mean if we're valuing the firm for all stakeholders, and what does it mean if we're valuing the firm for just owners? So if we're valuing the firm for all the stakeholders, then we'd be getting FCF D plus E, okay? And what that is going to be is the free cash flow before any interest is paid, because the interest gets paid to the debt holders. And we're always going to assume that the debt maturities are simply rolled over. So in other words, if we have a 5-year loan for $5 million, at the end of the 5 years, we go to the bank and they say, oh, okay, we'll give you another 5-year loan for the same amount. That's what rolling over means. And if we are interested in valuing the firm just for the owners, not for all the stakeholders, but just for the owners, then we're going to be interested in FCF sub E, which are the free cash flows available to owners in this case, just the owners. So these are going to be free cash flows that occur after interest has been paid to the debt holders. So some of the key features of these cash flows, for all of them, they're always going to be adjusted for project-specific risk, and we're always going to compute our cash flows after the entity pays its income tax. So these are going to be called after-tax cash flows. If we're getting the cash flows to all the stakeholders, to the debt holders and the equity holders, these are called unlevered free cash flows. And again, these are the free cash flows before any interest is paid, which means they're available to pay interest, to pay the debt holders, and to pay the owners. On the other hand, if we're getting our free cash flows just to owners, these are called levered free cash flows. And the reason that they're levered is because they occur after interest is paid, and these are the cash flows that are available to the owners. So you need to know this too. Unlevered free cash flows are for all stakeholders. Levered free cash flows are for owners. So now let's look at some formulas to compute the NPV of an entity that we're thinking of purchasing. Again, I want to look at this from the point of view of owners and all stakeholders. So if we're looking from the point of view of owners, right, E, and then we're going to get value of the equity. So we could say NPVE, standing for NPV to the shareholders, is equal to minus P comma E. What does that mean? That's the price that the owners paid to buy the firm. And as we know from our look at conservatives and cowboys earlier in the semester and a couple of other examples, if we set out to buy a firm, we don't have to use all of our money to buy 100% of the shares. We can use some of our money and we can get the firm to take out a loan to buy the rest. So that's why we've got P sub P comma E, okay, because that's the cost put in by the owners to get the shares, okay? Cost paid by owners. And then here we're just going to call the free cash flows FCF sub E, comma I. I stands for the year of that cash flow. And I will equal 1, 2, and for as long as we own the firm or till the firm collapses or something about that. We'll talk about where to cut off N a little bit later. And now we want to be discounting with the appropriate cost of capital for equity, ROCC, comma E. And that's going to be something that like what we get out of CAPM. Okay, on the other hand, if we're valuing the firm for all the stakeholders, for the debt holders and the equity holders, and that's what's called enterprise value. We learned about that in our ratio analysis chapter, right? If we're valuing a firm for all the stakeholders, debt plus equity, that's called enterprise value. And if we're valuing it just for equity holders, it's called the equity value. Okay, so this is going to look very similar, except now we're going to say this is the price to buy all of the firm's debt and equity, okay? And I'll explain more about that in a second. And these are going to be these unlevered cash flows that are available to all stakeholders here. And then we're going to have a different opportunity cost of capital that applies to all stakeholders. So we have a cost of capital here just for shareholders, and we have a different cost of capital here if we're valuing to everybody. So a little bit more on this price to purchase the firm for everybody. So like I said, this is the cost to purchase all of the equity and all of the debt of the firm. And what do I mean by change of control put here? Well, actually, this is something that can happen very frequently. Let's say that you own a firm and the equity, the market value of the equity of the firm is, say, 100 million equity, and you have 100 million loans for this firm. And I come along and I want to buy the firm. And I tell you, I'll pay 100 million for your equity for the firm, no problem. And you say, okay, great. So we think we have a deal. And as far as you're concerned, we do have a deal. But I got problems because your lender, let's say your lender for your firm is JP Morgan Chase, and Jamie Dimon takes a look at you and takes a look at me, and he says, I know you. You've done a great job with this firm. You're managing it really well. I don't know anything about this stinking Webster fella, and I think he might blow up the firm. He might manage it badly. He might do badly. So guess what? If he's going to own the firm, if the control of the firm changes, then I'm going to demand that all the principal of the loans I've loaned you have to be repaid immediately. And Jamie Dimon's not stupid. When you took out a loan contract with him, he put that in the loan contract. So you don't care. That's fine. But I do care because now all of a sudden I have to come up with 100 million to pay you for 100% of the shares. But I've also got to come up with 100 million to pay back Jamie Dimon for the loan. So what could I do? I could go to another bank, maybe Deutsche Bank, and say, hey, I'm buying this great firm, loan the firm $100 million, and the proceeds of that loan would go to pay Jamie Dimon at the time the firm was sold, something like that. So that's what we mean here by this change of control put. And it's true, it's really true. Oftentimes when you buy a firm, even though all you care about is owning 100% of the shares, you also have to refinance the debt. You have to come to an agreement with the current lender, or you've got to find a new lender to pay off the current lender when you buy the firm. Okay, enough of that. Okay, so next up, let's figure out how to compute free cash flows to owners and our cost of capital for owners. And that's going to be when we're working on NPV to shareholders. Let's also find out how to compute our unlevered free cash flows that are available to everyone and the associated opportunity cost of capital for all stakeholders. And this is going to be when we're finding the NPV to all stakeholders, NPV for D plus E. All right, so let's start with owners. Let's start with how to compute our free cash flows to owners. So these will be our FCFEs. So here are some methods for doing this. For all scenarios, let's consider a simple case to start off with these assumptions. So we'll say we have simple accounting. Hooray for that, right? Okay, we'll keep the accounting simple. You accounting majors, you got to go elsewhere for more complicated stuff here. So what do I mean by simple accounting? Let's say that depreciation is the firm's only non-cash expense. And let's say there's no preferred stock or anything like that. Okay, let's keep it simple by saying that the free cash flows are going to be the maximum dividends that can be issued to owners without impairing the future prospects of the firm. How do owners get free cash flows from a firm? They get them as dividends, okay? And when they get dividends from a firm, if that dividend is the maximum amount the firm could issue without impairing its future prospect, then it's a free cash flow dividend. So to owners, important thing to remember, free cash flows always come out of entities to owners as dividends. And finally, let's also say our free cash flows are project risk adjusted. And that corresponds very well to our CAPM model, our opportunity cost investment model, and generally all the ways that we've been thinking about our opportunity cost of capital. That way we'll be sure we have all the risks and we're not double counting any risks. Okay, so let's look at a couple methods for getting these quantities for owners. So and we'll use these in method A, we'll use these above assumptions, and we can show, and you can go look at this. I know some of you are so excited about this. You can go, if you're so excited, you can even jump ahead and look in Appendix A to see how this works. But in Appendix A, we show that the free cash flow in a given year I to owners is, as we know, the total cash flow that can be dividended without impairing the firm. And that's going to be the most that we can get to the owners via dividends coming from operations, coming from investing cash flows, and coming from our financing cash flows, right? From our three buckets of cash flows. And now if I just expand that out a little bit, remember that cash from operations, this comes from accounting, and if you've forgotten it, how can I blame you? But cash from operations, if we have simple accounting, like we said we had on the previous page over here, our simple accounting, if we have simple accounting, cash from operations boils down to net income plus depreciation minus changes in working capital. And investing cash flows, if we have simple accounting, is going to be just CapEx. So let me just draw some arrows here. So that one goes there, and this one, our investing cash flows are just CapEx. And if we have our simple accounting, our financing cash flows are going to be just changes in debt. So this is the key formula to remember. So this is one to put down in your helper sheet, and remember that free cash flows to owners in year I are going to be net income plus depreciation minus changes in working capital in year I, minus any capital expenditures in year I. Remember, that's repairing our buildings, repairing our planes if we have planes, maybe buying new planes, that sort of thing, and any changes to debt in year I. And a few more things to say about this is if year I is in the future, which is what it's going to be usually, to get this free cash flow, we're going to have to do what? We're going to have to project an income statement. That's how we're going to get our net income projection. We're going to have to project a balance sheet. That's how we're going to get the debt. And we're going to have to project a cash flow statement for that year. That's how we're going to get the CapEx. So when you do that, these are called pro forma projections. And pro forma projections are just projections of our financial statements into the future. So to get all this stuff that we need, the free cash flow we're going to get from a firm as a dividend for the owners, say I equal to 2 years from now, we're going to have to project and estimate what the income statement is going to look like 2 years from now, the balance sheet and the cash flow statement. And also, what's more, is the financial statements that we project have to be calculated so the dividended amount is the maximum we can dividend without impairing the future of the firm, and that makes it a free cash flow. Okay, so method B, how could we get our free cash flows to owners from method B? Okay, we can use our equation from accounting, our roll forward equation for equity. And this hopefully you remember from financial accounting, but again, I don't blame you if you don't, but this roll forward equation from financial accounting says equity at the end of the period equals equity at beginning of period plus additions to equity from net income and paid in capital, that would be issuing more shares, minus dividends. Dividends would be what we give out to the owners. So if we want to use this method, we're going to, no ifs, ands, or buts about it, we're going to have to project forward future balance sheet, income statement, and cash flow statement. And we're going to note that the dividend here, if we calibrate these financial statements properly, the dividend is, in fact, the free cash flow amount that goes to the owners. So really all we have to remember here is that we've got this roll forward equation, and now instead of just calling that dividend, if we have everything calibrated properly, this will be the free cash flow to owners. So we just solve this equation for free cash flow to owners. Also, very important to note, if we haven't made any mistakes along the way, numerically what we get out of method A will be exactly equal to what we get out of method B. Why? Because in both cases, remember, we do have to project forward our financial statement. So we're really using the same information. We're just using it in different ways in method A and method B. All right, so now let's see how to compute free cash flows to all of our stakeholders. Okay, so we want to consider the same very simple accounting that we had above. Okay, so let's start with what we had for owners. Free cash flow in year I to owners is equal to net income plus depreciation minus changes in working capital, etc. So this is our method A method. And to adjust this for all owners, it's pretty straightforward. All we really have to do is replace up here net income with EBIT minus tax. And what's EBIT minus tax? That's cash and accruals to lenders and owners. Net income is cash and accruals from operations to owners. So we're replacing that with cash and accruals to lenders and owners. That's what EBIT minus tax represents. Remember, all of our cash flows we want to be after tax. So that's why we include this tax term here. One other thing you should know here is that everyone in the world in finance calls EBIT minus tax NOPAT, and that stands for net operating profit after tax. So you just need to know that NOPAT is equal to EBIT minus tax. So now if we substitute that in, the free cash flows in year I to everybody, available to everybody, to debt holders and shareholders, is just NOPAT plus depreciation minus changes in working capital minus CapEx in the year plus changes in debt in the year. So you see, very similar. We've just replaced net income with NOPAT. Okay, as with our free cash flows to owners, we're still, to do this, no ifs, ands, or buts, no way around it, we're going to have to project forward, estimate our income statement, balance sheet, and cash flow statement in each future year I. So we are going to need these. Pro forma projections are these estimates in future years of these statements. And as usual, when we do project forward these statements, we want them to be calibrated so that the free cash flow is the maximum amount that could be awarded to lenders and owners without impairing the future of the firm. Okay, so that's it for cash flows. So we know how to get cash flows if we're valuing the firm for everybody, all stakeholders, and we know how to get the cash flows if we are valuing the firm for the owners. So Yahoo for that. Okay, now what is next up? We have to think about what is the appropriate discount rate to use, what opportunity cost of capital to use. So this is going to be two things we're going to look at. RE, that's going to be for owners, and our WACC, which stands for our weighted average cost of capital, that'll be for everyone. So let's jump into this. So what is the right opportunity cost of capital in these two cases, valuing for owners, valuing for everybody? That's going to be what we're going to call, when we're looking for owners, ROCC comma E, meaning opportunity cost of capital for just owners. And when we're valuing the entity for everyone, we'll call that ROCC D plus E. Okay. And so what are the right costs of capital discount rates to use? Two answers to this question. We want to have, of course, an opportunity cost of capital that includes risk-free risk and an increment for our market risk, because we've got project risk in the cash flows, and if we do this, we'll have all our cash flows. So that's good. And in general, when we're valuing a firm, trying to get an NPV for owners, the appropriate opportunity cost of capital is going to be called RE, and that's called the cost of equity financing or the cost of equity capital. And guess what we use for that? Oh my God, I'm sad to say. We typically use CAPM for that, even though we know it's not great. And just parenthetically, let me say here, I didn't spend too much time on this, but we also spent a lot of time with the opportunity investment model. The opportunity investment model is really good for things like bonds where you have contracts and it's easy to find an opportunity cost investment. CAPM is used more frequently in equities when we're trying to value the equity of a firm because, as you know, there are no contracts involved in that. So it's a more mathy, statistically driven model that is used more frequently for equity. You could use the opportunity investment model. It's just CAPM is still, as we know, very popular. Okay. All right. So when we're valuing the firm for everybody, we're trying to get an NPV for debt holders and shareholders. The discount rate that we're going to use is called RWAC, and that stands for our opportunity cost. Sorry, yeah, the weighted average cost of capital. Sorry about that. And this is something, again, we just need to know. We have a formula here for the weighted average cost of capital, and it looks like this: one minus the tax rate quantity times all this other stuff, which I'll explain in detail on the next page. So here we are on the next page, okay? So we're using this discount rate, our weighted average cost of capital, when we're valuing a firm for debt holders and shareholders. And what's that? That's when we're getting the enterprise value of the firm. And remember from the previous page, the weighted average cost of capital, which a lot of people just call WACC. Okay, so if you see this, WACC in caps, they mean the discount rate that is weighted average cost of capital. So it's equal to this formula. And what's everything in this formula? First of all, what is RD? RD is our pre-tax cost of debt financing. And we're typically going to use in the previous chapter, we learned several ways to compute our pre-tax cost of debt financing for an entity. And in this chapter, going forward, we'll probably use this. We'll just go from the income statement here. Remember, this doesn't include the tax shield, even though we're taking it from the income statement. The interest paid divided by the debt at the beginning of period, and we want to make sure we include all the debt in there, okay? This is still pre-tax because it doesn't have the tax shield in there, okay? And this is how we get post-tax, by multiplying it by 1 minus the tax rate. Okay, so let's move on here. Tax rate in this equation is our income tax rate, and as we know, 1 minus the tax rate is the effect of the tax shield, and it reduces our cost of debt capital, which is going to reduce, as you can see, our weighted average cost of capital up there. Okay, and RE in this equation is exactly what it was on the previous page. It's our cost of equity financing, which we'll get from CAPM. Typically, we could get it from opportunity investment model. We could get it from a modified version of CAPM, etc. So what are these little W's running around in this equation? We have a WD and a WE. WD is the weight of debt financing, and we measure the weight like this. I just want to underline this guy. We measure the weight of debt financing by this ratio, debt over debt plus market value of equity, okay? And debt is pretty much going to be fine to get our debt just from the balance sheet, the GAAP value of the firm's debt. The E here, the equity market value, really should be the estimated market value of the firm's equity. Sometimes, if we're valuing a private company and the estimated market value of the firm's equity is not available, and that's sort of the whole point of the exercise here, then we're going to use the GAAP value of the equity. No shame in that, no harm in that. If you don't know an estimate for market value of equity, use the GAAP equity value. And then finally, we've got everything in this equation now. We've got our tax rate. Our 1 minus the tax rate accounts for the tax shield. We know how to get RD. we know WD is the weight of the debt, RE is our cost of equity capital from CAPM or something, and WE is simply the weight of our equity financing. So that'll be our hopefully market value or gap value of equity divided by quantity debt plus equity. And also notice that this is equal to 1 minus the weight of the debt. And that also leads me to point out that WD and WD always add up to 100%. So that's another good way to check your work. Make sure these two add up to 100% or 1. So what does this really mean? Our weighted average cost of capital is really just a weighted average of our post-tax RD, right? Of our post-tax RD and our RE, our cost of capital. So that's really all this equation is telling us. Not that complicated, not that big a deal, and it gives us something we can use to discount with when we're trying to get an NPV for everybody, for owners and lenders. All right, a little review on the tax shield here. It's in gray. You don't have to worry about it. Let's jump right into an example. So let's compute the weighted average cost of capital for Zero motorcycles. So let's say Zero just reported a balance sheet and an income statement, which I'll get to in a minute. But let's look at the balance sheet. So these are in millions. So they have 50 million in current assets. They have net PP of 100 million, total assets 150. They have short-term debt of 25 million, other current liabilities, long-term debt of 50 million, and we get down here to their equity, which is their total assets minus their total liabilities. 150 minus 125 is 25 in most circles, so Yahoo for that. And let's see what these notes say here. So debt balances have been constant for the past year. Okay, so that's great. Okay, so that means in the most recently reported balance sheet, it was 25, but also the year prior balance sheet, it was also equal to 25. And same thing for the 50 down here. So that's good to know. Otherwise, we would need balance sheet from last year, and you'll see why in a second. Okay, what's our second note here? Equity market value is equal to equity gap. Okay, that's good. And this does happen, not with some infrequency, that the gap value of equity happens to be pretty close to the market value of equity. So that's good. So we can just use this for our market value of equity. And while we're down here with the notes, let's see what this says. The firm estimates its RE at 20%. We know from the last chapter how they did that, right? They probably used CAPM and got their beta, estimated their market rate, all that jazz, and did what we did in the last chapter to estimate their RE. Okay, so now let's go ahead and look at their income statement. So in the past year, they had 50 million in revenue, COGS and SGA of 20 million, interest of 10, tax at 5, and net income of 15. Okay, good. So this is what we know about Zero motorcycles, and what are we asked to find? The company's weighted average cost of capital. Okay, so we only have one equation for that. Weighted average cost of capital is going to come from this equation. So we just need to make sure we have everything to plug into this equation and then just plug it in. Okay, so for the pre-tax cost of debt financing, that's going to be what? The interest divided by the total debt BOP, right? That's the way, if we're getting our cost of debt financing from financial statements, this is always the way we get our pre-tax cost of debt financing. So what's that equal to? I have no idea, but let's go back and find out. So the interest was 10, okay, and the total debt, short-term debt, long-term debt, has nothing to do with short-term, long-term. We want all the debt, right? Because they're paying, this interest payment came from all of it. Didn't matter if it were short-term or long-term. So 25 plus 50, that's 75 in most circles. So we have, whoops, sorry, I've forgotten already. So we have 10 over 75. Okay, 10 divided by 75, and that's equal to, I think, 0.133. But let's go ahead and check that here. Yep. Okay, so that's 0.133. Okay, so our tax rate is our income tax rate, and that is always our tax divided by our EBT. Okay, and let's see what we had here. Our tax was 5. Okay, and EBT is going to be, okay, our EBT is equal to 15 plus 5 or 20, right? Because that's earnings including everything except for tax. So with tax, I got 15. If we back out the tax, it's going to be 20. So we have 5 over 20. And I can even do that one in my head. That's 0.25, right? Because 5 times 4 is 20. Okay. And our cost of equity financing, that was given. They probably got that from CAPM or something like that. And the weight of their debt financing. So that's going to be what? That's going to be, we want D over D plus E. Okay, and that's going to equal the total debt there is 75 divided by 75 plus what's their equity? Their equity is 25, and happily it says the market value is similar to the gap value, so we'll go ahead and use that. 25, so 75 over 100 is equal to, there's another one I can do in my head, is equal to 0.75. So that's looking good. Okay, so the weight of equity financing is E over D plus E, and that's 25 over 75 plus 25, and that's equal to 0.25. Okay, so let's just do a little check here. Is 0.25 plus 0.75 equal to 1? Yes, okay. Good for us. All right, so that checks. So now we can just plug in, we've got everything we need to plug in for the weighted average cost of capital. So this is going to be 1 minus the 0.25 is their tax rate times what's their pre-tax cost of debt financing, 0.133. Whoop, that's correct, it's just in the wrong place. We want that times 0.133, and now we have to multiply that by the weight of their debt financing. So that's going to be times 0.75, and now we have plus, I think I'm done with the debt term, okay, their cost of equity capital, they estimate at 20%, 0.2 times the weight of equity for them is 0.25. And let's just plug that into Excel and see what we get here. Okay, I got 0.125 or 12.5%. Okay, so that's it. That's how we compute the weighted average cost of capital for a company. So no big deal, pretty straightforward. And this is what we would use to discount with if we're trying to get an NPV for all stakeholders, for debt holders and shareholders. Okay, so now let's sort of summarize a little bit because we've gone through a lot of stuff here. So let's summarize our quantities for the NPV methods for valuing entities for owners and stakeholders. So first of all we're going to do, and this is going to be true for the rest of the term, happily, we're going to use our simple accounting cases where depreciation is our only non-cash expense, et cetera, et cetera. Okay, so in that case, when we're trying to get an NPV for shareholders, this is the equation, again, that you need to know. Free cash flow to owners in year I is going to be net income in that year, plus depreciation in that year, minus changes to working capital in that year, minus capital expenditures in that year, plus any changes to the debt in that year. And again, these are what we call the levered cash flows. They're levered because they come after we pay interest. They represent and include the effect of that leverage of having to pay that interest, okay? And the discount rate that we're going to use in our NPV equation is just going to be our RE cost of equity capital as we've learned to compute from CAPM, or we could estimate from the opportunity investment model, or et cetera. And again, CAPM is really equity-focused way to get RE. Opportunity investment model is really good for things like bonds, anywhere where you have a contract, and it's honestly not as good for something like equity where there's no contract and it's just very hard to find an opportunity investment that's a diversified portfolio stuff, et cetera, et cetera. Okay, so now how about finding NPV for all our stakeholders? So again, I'm just summarizing what we've done so far. So our free cash flow is going to look very much like the formula up above, except we exchange net income for NOPAT, and NOPAT is equal to EBIT minus tax. Okay, and other than that, it's exactly the formula that we had up here, so not too much extra to remember. These are the unlevered cash flows because these are the cash flows before we take into account that leverage, having to pay the interest on the debt. And in this case, the cost of capital that we want to use, the discount rate that we want to use, is our weighted average cost of capital, which comes from the equation we just beat to death. Okay, so going forward for the rest of the term, we're going to focus on NPV to owners unless otherwise stated. So we're not going to be so concerned with finding NPV to all stakeholders. We're going to be focused more on NPV to owners. Okay, and I bet you thought you were not going to see my ugly mug anymore in this lecture, but you would be so wrong. But I just want to say, take a moment here to say to you all who have pointed out, very rightly so, I think, that these lectures are, that's a better background. Look at that, there are solar panels in the background, very cool. So you've pointed out that these lectures are way too long on video. I totally agree with that. So why don't you right now hit that pause button, note where you are in the time, what the time is, and go away, hang out with your friends, chat, play video games, read a little bit from your favorite finance textbook, and come back a little later and finish this lecture. All right, and we'll pick it up when you do that. Talk to you very soon.